Thing is, I don't want you to be intimidated by this section. A lot of people are thinking right now, oh no, Ed's going to talk about fundamentals. I won't be able to understand it. It's too tough. I'll just skip it. Don't think that way. Anyone can understand fundamentals, and I'm going to try to explain it in a way that anyone can understand. I want you to just think of the following 3 words. Follow the money. That's all fundamentals consist of. Those 3 words. Follow the money. We're going to follow flows of money from investments. Those are called capital flows. We're going to follow flows of money from trade. Those are called trade flows. It's not too tough. So the fundamentals are what drive the long-term movement in a currency pair. So if you see a chart and the currency pair is trending in the long term, there's something fundamental driving that trend. You could say that the trend itself on the chart, which is a technical phenomenon, is created by the fundamentals. So I don't want you to think of technicals and fundamentals as being completely disconnected the way many traders do. The fact is, the technicals and the fundamentals are intertwined. They're very closely related. Trade flow and capital flow create supply and demand for currencies. And again, think of those words. We're just going to follow the money. Wherever the money is flowing, that's the currency that is going to benefit the most. Every day, huge amounts of capital are invested. Capital flows, investment capital. Imagine this, a country that has an attractive investment, maybe a hot stock market or high-yielding bonds. That investment is going to attract money from around the world. It's like a magnet. It could be an equity market, it could be real estate, it could be bonds, it could be another type of investment. But a very attractive investment, no matter where it is, that's going to attract funds like a magnet, and when those funds pour into the country from overseas, the currency tends to strengthen. Again, it's just a game of follow the money. It's really not that complicated. If capital flows out of a country, right, if capital is leaving your country to be invested overseas, that's going to cause your currency to weaken. So it works both ways. When capital flows into your country, it creates demand and it causes your currency to strengthen. It's not that complicated. So, for example, what if interest rates are going up in your country? What if they're going higher? Rising interest rates attract capital. Why? Because it makes that country's fixed income investments more attractive. So if the bond yields are particularly high in one country, or the rates are going higher in one country, that will pull money from around the world like a magnet into that country and cause the currency to strengthen. It's not necessarily created by interest rates. It could be a hot stock market. It could be a hot real estate market. Any of those could attract investment capital from around the world and cause a currency to strengthen. Think in terms of the NASDAQ in the United States, circa 1999. The NASDAQ went all the way up to 5,000 because of the tremendous flow of capital coming from around the world to buy U.S. tech stocks. When that capital left the United States, the NASDAQ collapsed. So it's really all about capital flows, all about investment capital. You follow that money. The country that is benefiting from the capital flow is the country whose currency will benefit. For example, suppose that U.S. investors decide that Japan's real estate market is undervalued. Maybe you are a huge real estate investor. You're part of a consortium that buys apartment buildings, shopping centers, etc. Let's suppose that these U.S. investors decide to sell their apartment buildings in the U.S. because they've already appreciated quite a bit, and take that money and reinvest it in shopping malls in Japan. Who's going to benefit? Well, what happens? If a U.S. investor sells U.S. real estate, what are they going to receive in return? U.S. dollars. But I can't buy that Japanese shopping mall with my U.S. dollars. I have to do what? I have to exchange currencies. I have to sell the U.S. dollar and buy the Japanese yen. Now, if one or two people do this, it's not going to move the currency. But what if there's a movement around the world? What if money from all around the world begins pouring into Japan to take advantage of real estate? That's going to create a capital flow into Japan. That's going to cause the yen to strengthen. It's just one example of how a capital flow can cause currencies to strengthen. Another example, suppose a hedge fund wants to take advantage of a hot stock market in the UK. Maybe the FTSE index is doing very well that year. And the hedge fund decides they want to sell their non-performing holdings and reinvest that money in UK stocks. So maybe they decide to sell their Japanese stocks. And what happens when you sell Japanese stocks? What do you get in return? You get yen. You can't buy those UK stocks with yen. You must sell the yen and buy the British pound. And if enough investors around the world are selling the yen and buying the pound, that creates a capital flow into the UK and out of Japan. Once again, it's just a game of follow the money. Another example, take large global fixed income funds. They're specifically looking for bonds in which to invest. Now, all things being equal, they're going to go with the best yield they can get, as long as they can also receive what? Safety. So, if bonds in the UK are very attractive, if they're yielding more than, say, European bonds, it's very likely that this fixed income fund might sell their European bonds, reinvest that money in UK bonds. But when you sell your European bonds, you receive euros. You can't buy the UK bonds with the euros. I'm going to have to sell the euro and buy the British pound. If enough of these funds are doing that, it's going to create a big flow of capital out of Europe and into the UK. That takes care of capital flows, but what about trade flows? Think of trade flows as that is simply the balance of imports versus exports. Goods are flowing back and forth between countries, and currency is also flowing back and forth between those countries. It is simply supply and demand. If you're a net exporter, for example, like Japan, which has an export-based economy, there's a natural demand for your currency. In other words, a natural tendency for your currency to strengthen due to the fact that you're a net exporter. On the other hand, if you're a net importer, such as the United States, there's a natural supply of your currency. There's a tendency of your currency to weaken due to all the importing activity. But as we'll see with the United States, that's going to be offset by the capital flows flowing into the United States to take advantage of investments. Now, the importing country must pay for the goods that it is importing with the currency of the exporting country. So, if I'm in the United States and I am buying goods from Sony or Toyota, I'm going to pay them in yen. I have to sell my currency and buy the yen. So I'm selling the US dollar, I'm buying the yen. And if this is happening in large quantity, that's going to cause the dollar to weaken and the yen to strengthen. Once again, it creates a flow of capital to Japan. Now, Japan's economy is export-based, right? And the constant stream of goods that are flowing out of Japan result in a stream of capital flowing back into Japan. The US, on the other hand, is a major importer of goods. Those goods flowing into the US result in a constant stream of capital flowing out of the US to pay for those goods. How does this balance out? Well, that equation is called the balance of payments. And the balance of payments is simply the balance between capital flows and trade flows. For example, if the US dollar is weakened, and it is by its huge trade imbalance, because, of course, the US is a major importer, that trade balance can be offset by the huge capital flows that are coming into the US, especially from large Asian central banks like China and Japan. There's a tremendous amount of money flowing out of those countries and into the United States to buy U.S. treasuries and other investments. So, we can see that the U.S. trade deficit has been growing steadily over time. And if this trade deficit is not offset by a corresponding capital flow, the U.S. dollar will collapse. Fortunately for the U.S. dollar, the trade imbalance is offset by a huge flow of capital coming back into the U.S. to invest in U.S. treasuries, in bonds, in stocks, and in other investments. Let's talk for a minute about interest rates, because out of all the fundamental factors that are affecting the currency markets, interest rates are probably the most frequently discussed. And for very good reason, because interest rates have a huge impact on capital flows. We just talked about how higher interest rates can attract funds from around the world into a country. So naturally, we want to be aware if a country is considering raising or lowering their interest rates. Now, many large pension funds and other institutions invest in fixed income because they may have rules that say they're not allowed to invest in equities or other investments, maybe only allowed to invest in fixed income. So there's a huge flow of money out there looking to invest in fixed income at all times. These investors are constantly looking for the best combination of return and safety. Now, if the market perceives that rates are going to rise faster or fall more slowly than previously anticipated, the underlying currency strengthens. But vice versa is also true. If the market perceives that rates will fall faster or perhaps rise more slowly than previously anticipated, the underlying currency will weaken. We need to monitor the interest rates of all the countries that we're trading at all times. They don't change that frequently, but we do need to keep our eye on them to see which ones are rising and which ones are falling, because the ones that are rising are much more likely to attract capital flows. Let's take, for example, what if Great Britain raises interest rates by 0.25% or 25 basis points? Now, suppose that a fixed income fund is holding on to U.S. treasuries, and those Great Britain bonds now seem maybe a little bit more attractive because the rates have gone up in Great Britain. So maybe that pension fund is going to sell the U.S. bonds, and what do they get in return when you sell U.S. bonds? You get U.S. dollars. Can't buy the British pounds with U.S. dollars? That means you're going to have to convert your U.S. dollars to British pounds to take advantage of those more attractive UK rates. So when the interest rates are rising in a country, it often can create a flow of funds out of other countries and into the country whose rates are rising. Essentially, that fixed income fund would be selling the dollar and buying the British pound. And if that happens on a large scale, if all the funds start doing that, it's going to create a huge flow of capital out of the US and into Great Britain. That's going to cause the Great Britain pound to rise against the US dollar. Now, how can we monitor potential changes in interest rates? Well, there are futures contracts for the different countries that we're speaking about. These futures contracts tend to be accurate predictors of future interest rates. And the reason for that is because there's real money behind these contracts. It's not some analyst saying, I think rates are going to go to this point or that point. It's real money that sets that rate. So if we follow those rates closely, that may give us some insight into the future of interest rates. In the United States, the Fed funds futures trade on the Chicago Board of Trade. This futures contract is a key indicator of U.S. interest rates. It gauges the market's expectation of changes in U.S. monetary policy. Now, if we look at this graph, on the left, you're seeing the month. Every month has a new contract. Second column from the right is settle. That's the most recent price. Now, it may look like a jumble of numbers to you right now, but it's really very simple. I'll explain. You simply take 100 and subtract the price quoted. That's going to give you the average interest rate for the month traded. So, for example, The February contract traded very close to 96. 100 minus 96 is 4. So the Fed funds futures are predicting an average interest rate of 4% for February. Not too difficult, right? Now, these type of futures are available not just in the United States, but also in Europe. In Europe, on the Eurex, we have the Euribor futures. And these are a key barometer of European interest rates. You just read them the same way. You simply take 100 minus the price quoted, and that equals the average interest rate for the month traded. So, for example, if you look on the column second from the left, it says delivery month. Let's say that delivery month of March has 97.57. You simply take 100 minus 97.57, and you'll get the predicted average interest rate for March for the euro. Now let's talk about economic indicators. Now, these are simply economic reports that measure the strength or weakness of a particular segment of the economy. Think of it as a report card for a segment of the economy. Now, the different countries all have different economic indicators, but they basically all measure the same thing. They all measure employment, or manufacturing, or sales. They measure inflation, gross domestic product, consumer confidence. All of these things are measured in all of the countries that we're trading. And when you take them as a whole, they create a perception as to the strength or weakness of the economy. Now, if indicators are generally coming out stronger than anticipated, that usually means the economy is strengthening. And one side effect of a strong economy is inflation. So follow me here. How do we fight inflation? Central banks will raise interest rates to fight inflation. And you and I already know that a higher interest rate is going to attract investors because higher rates act like a magnet, drawing money in from around the world. So, if you're seeing a strong economy, that currency is going to strengthen in anticipation of higher rates. If indicators, on the other hand, are weaker than expected, on a consistent basis, it could mean that the economy is weakening. Now, how do we jumpstart a weak economy? We lower interest rates. You and I know that lower interest rates repel investors. Investors want the higher rate. So, the underlying currency of the country that lowers their interest rates is very likely to weaken. On the other hand, let's just say that economic indicators are coming out exactly as anticipated. We really shouldn't expect any reaction from the market at all. This is because the anticipated result is already priced into the market. And because the results are exactly as anticipated, there's no reason for anyone to change their positions. There's no type of turmoil in the market. There's no adjustment that's needed from the market. You can see that there are many different economic releases from all around the world that are constantly being released. But I want to tell you, don't be intimidated by this. You certainly do not need to follow or understand every economic indicator on the screen. But one important issue that really should be dealt with is that many traders make the mistake of looking only at the headline number and ignoring the underlying components of an economic indicator. So perhaps there's an economic release and everyone is focused on that headline number. If you're only looking at the headline number and you're not looking at the underlying components, you're really only looking at one piece to the puzzle. And this is why so many traders find the market's reaction to an economic indicator confusing. I'll give you an example. Every month, the United States releases an employment report. And most traders are focused very squarely only on one element of that report, the number of jobs created. That number is referred to as non-farm payrolls. What these traders misunderstand is that the U.S. employment report is actually a series of reports that are released simultaneously. If you're only looking at one piece of the puzzle, you're going to miss the point because there are a tremendous amount of underlying components involved in this report. All of this information is hitting the market simultaneously. If we're only looking at one piece of the puzzle, the market's reaction is not going to make sense. What happens is, this report frequently creates what I would call a knee-jerk reaction. In other words, there are traders who are hovering over the keyboard, they see the headline number, as soon as they see it, they bite, and the price runs in one direction. But remember, these traders are not looking at the big picture. The market frequently will reverse after traders have had time to consider all of the underlying components and all the information released in the report. As a case in point, I'd like you to take a look at some of the reactions to recent non-farm payroll reports. In this case, traders go long the euro-US dollar immediately upon the report because they haven't looked at the underlying numbers. When the underlying numbers become apparent, the price reverses and heads in the other direction. Here's another non-farm payroll report where the price swings wildly. You can see that candle in the center of the screen, and the price moves to the upper end and the lower end of that candle before finishing right where it started. That's obviously going to be a very difficult event for many traders. And yet another euro-US dollar reaction to a non-farm payroll report. And again, you see a huge knee-jerk reaction in one direction by the traders who are only looking at one component of the report, and all of these traders are going to have to run for cover because the market turns and goes the other way when it has digested all of the information that has come out. So let's assume that job creation, the actual headline non-farm payroll number, comes in below expectations, signaling a weak economy. The knee-jerk reaction by many of these traders is to sell the US dollar. In other words, go long Euro-USD. And of course, Euro-USD rises very, very quickly. However, they're not looking at the underlying component of the unemployment rate. If the unemployment rate is falling, that signifies that the pool of available workers is shrinking. Now, what does that mean? Well, think about it. What if you're an employer and the pool of available workers is shrinking? What does that mean to you? It means you're going to have to raise wages. You're going to have to pay more because there are fewer people available to hire. Now, if we raise wages, that creates inflation. And how do we fight inflation? It all goes back to interest rates. We fight inflation by raising interest rates. So you can see that the two components of the report conflicted, and traders who ignored the unemployment rate missed the boat. You can see by this graph that on a consistent basis, when the unemployment rate rises, earnings fall. And when the unemployment rate falls, earnings rise. It's a very strong, what we call negative correlation there. In other words, when one rises, the other one falls. Okay? Now, I have to tell you that in my experience as the chief trading instructor at a major market maker, I have the ability to look in many people's accounts, and I can tell you that the non-farm payroll report is probably the single most devastating event for most traders. In other words, there are many traders who are trying to trade this event, but they honestly, a lot of them don't understand the full scope of what's happening. In fact, it's such a difficult event to trade. Even interbank participants, the big traders at the heart of this market, have been known to pull their quotes at the time of this release. And that's why most market makers do not guarantee stops during the non-farm payroll report. Now let me ask you something. Since you have guaranteed stops virtually all the time in the Forex market, why would you want to trade the one event where you do not have a guaranteed stop? In other words, if you have a safety net almost all the time, why would you trade that one event where you do not have a safety net? The answer is smart traders avoid this event because it is a devastating event for many, many traders. Let's talk about some of the characteristics of the currencies we're going to be trading. Each of these currencies and each of these countries has individual characteristics, and it's important to understand what makes them tick to really know what's going to move them. Let's talk about the US dollar first. Why? Because 90% of all Forex transactions involve the US dollar. So, news and economic events that affect the US dollar are going to take on added significance. Everyone is watching indicators that affect the dollar. The economy of the US is huge. It's $12 trillion gross domestic product in 2004. Now, we said before, there's a big flow of money coming into the US. That's because the US possesses the most liquid fixed income and equity markets in the world. About 70% of the world's savings ends up in the United States, invested in US stocks, US bonds, US banks. Now, the US runs a huge trade deficit, about $700 billion last year. Now, that means that the US needs about $2 billion every day in capital flowing back into the US to balance its books. Now, of course, we spoke about that relationship earlier. The US is a huge importer, and that means a big flow of money heading out of the US, but also the US is the beneficiary of huge capital inflows coming into the US to buy US treasuries and other investments. The US dollar has an inverse relationship to the price of gold. This means that when the price of gold rises, the US dollar tends to fall, and vice versa. For example, if you take a look at this chart of gold, just sort of drink it in, look at the whole formation and the shape of it. I'm going to compare this chart now to a chart of the euro-US dollar currency pair. And you'll notice there's a great deal of similarity there. Now, when this pair rises, the US dollar falls. So we can see very clearly there's an inverse relationship between gold and the US dollar. The British pound. First of all, it's very important to understand the UK is the world's capital of Forex trading, and the volume is extremely high during UK trading hours. Due to a lot of energy production, and the fact that there are some very large energy companies in the UK, such as British Petroleum, there is a strong correlation between the Great Britain pound and energy prices. It's also important to consider that European nations account for 50% of trade with the UK. So, if European economies are weakening, that could hurt British exports. What about the euro? The European Union currently consists of 25 nations, 12 of which use the euro as their common currency. Those 12 countries are called the EMU, the European Monetary Union. The European Union was established by the Maastricht Treaty of 1992, and the euro itself has a positive correlation with the price of gold. It's important to understand the biggest EMU members are Germany, France, and Italy. So, if economic indicators for Germany are being released, they're obviously going to have a big impact on the euro, because Germany is the biggest country out of the 12 that are currently using the euro as their currency. Let's talk for a minute about the Canadian dollar. A lot of people don't realize that Canada is the world's 5th largest producer of gold and 14th largest producer of oil. Because of this, the Canadian dollar tends to rise when these commodities prices rise. The Canadian dollar is what we call a commodity currency. Also, it's very important to understand that Canada borders the US, and the US purchases 85% of Canada's exports. This means that if the economy in the US is strong, Canada will benefit because of the tremendous amount of exports that Canada sends to the United States. Also, Canada runs a budget surplus and a trade surplus. They have a very healthy bottom line. Let's talk about the yen for a minute. Japan has an export-driven economy, and the Bank of Japan often intervenes in the currency markets to keep the yen weak. The weak yen makes exports affordable, and it's important to understand, too, that Japan has very little energy production. The yen has a negative correlation with energy prices because Japan imports virtually all of their oil. So when there is a shock in the price of oil, when oil prices are rising, it could have a negative impact on a lot of currencies, but it's probably going to hurt the yen worse than the others. The Swiss franc. You know, Switzerland is physically small, but economically speaking, they are a giant. 35% of the world's wealth management takes place in Switzerland. And the country is home to some of the biggest banks in the world, like UBS and CS First Boston. The Swiss franc is a safe haven currency because of its famous political neutrality. So in times of turmoil, in times of war, the Swiss franc tends to benefit as money flows into Switzerland and out of troubled countries. The Australian dollar and the New Zealand dollar. Both of these currencies are commodity currencies. They rise when commodities prices rise. They have a positive correlation with gold and metals prices. Also, both Australia and New Zealand export agricultural products. And because of that, because of all the farming activity in these countries, they're sensitive to droughts and severe weather conditions. Now that we know more about fundamentals, let's take a look at ways that we can use them to our benefit. We talked about how certain currencies move based on commodities prices, oil and gold, for example, and how those are what we call commodity currencies. Well, currency traders monitor gold and oil prices, and that helps them to predict specific movements in different currencies. So, if you have fluctuations in the price of gold or oil or other commodities, the companies that drill for the oil or dig for the gold, their revenue will fluctuate in a corresponding manner. We can see from this chart that when oil prices rise, the Japanese yen tends to fall. But when oil prices rise, the Canadian dollar tends to rise. We can use that to our benefit. In fact, as a currency trader, essentially, I can use the Canadian dollar Japanese yen currency pair as a proxy for the price of oil. In addition to that, we can also see that when gold prices rise, the US dollar falls, but when gold prices rise, many of the commodity currencies, such as New Zealand, Canada, Australia, tend to rise. Switzerland also tends to rise, along with gold prices. Now, we said before the Japanese yen has a negative correlation with oil prices. Japan is the world's second largest net oil importer and is almost completely dependent on foreign oil. So when the price of oil rises, they're very much felt in the yen. On the other side of this equation, the Canadian dollar has a positive correlation with oil prices. The Canadian dollar rises when oil is rising because Canada is a major producer and exporter of oil. So the Canadian dollar Japanese yen currency pair is a good proxy for oil prices. If we take a look at this chart, and again, I just want you to lean back and drink it in, just get an idea of the general shape of the chart. This is oil, price of oil rising. If I put up a corresponding chart of the Canadian dollar Japanese yen currency pair, you can see that there are some similarities. Because of this, currency traders can use commodities prices to their advantage. We said that gold has an inverse relationship to the US dollar, an inverse correlation, meaning that when one rises, the other falls. Gold is considered the ultimate safe haven investment, and you'll see that during times of war, times of terrorist attacks, times of uncertainty and turmoil, gold tends to benefit. On the other hand, Switzerland is known for political neutrality, and money flows into Switzerland during times of uncertainty and turmoil. So, the Swiss franc tends to correlate highly to the price of gold because of its safe haven status and because of the ample gold reserves of the Swiss National Bank. Other currencies that benefit from the rising price of gold. The Australian dollar has an 80% positive correlation to the price of gold because there are many gold mining operations in Australia. The Canadian dollar has a 60% positive correlation to the price of gold, and New Zealand a 50% positive correlation. Certain currency pairs correlate to each other. And I'm specifically speaking about the Euro-US dollar pair and the US dollar-Swiss franc pair. These two have a very strong inverse correlation, meaning that one pair rises as the other falls. And these two currency pairs are often hedged against each other because their movements are almost completely opposite of one another. If you take a look at this chart, you'll see what I mean. It's almost like looking in a mirror. The chart at the top is the US dollar Swiss franc, and the chart at the bottom of the screen is a corresponding chart of the Euro US dollar. Again, almost a mirror image of each other. Mergers and acquisition deals can move the foreign exchange market. Consider this. What if there is a large cross-border merger or acquisition? The combination of two corporations, or the acquisition of part of a corporation, when that money flows across borders from one country to another, there is the potential for strong upward movement in the target corporation's domestic currency. Now, in this day and age, many mergers and acquisitions are all-stock transactions, and these stock transactions will have minimal impact on the foreign exchange markets. However, an all-cash transaction could have a strong reaction in the Forex markets. If the deal is a combination of cash and stock, which is fairly common, traders must assess and decide whether the cash portion is significant enough to move the currency markets. Let's talk about China for a minute, because China is very quickly becoming an economic powerhouse. Now, the Chinese currency does not float freely at this time. Chinese currency is called the yuan, and it used to be pegged to the US dollar at a rate of 8.3 yuan to the US dollar. That means that when one currency moved up, the other would move up in tandem, and vice versa. The dollar and the yuan would move up and down together. And this allowed the Chinese currency to weaken as the US dollar weakens, even though China has tremendous economic growth. By keeping the currency artificially weak, China's exports become more attractive to overseas buyers, and that creates a flow of capital into China. It also gives China what many believe is an unfair trade advantage over competitors from other parts of the world. Some analysts believe the Chinese currency is undervalued by between 15 and 40%, and at one point, US politicians were trying to pass a law that would put a 27.5% tariff on Chinese goods. They got the 27.5% figure because it's midway between 15 and 40%. Now, because of China's policies regarding its currency, China's trade partners have been pressuring China to allow the currency to float freely to create a more level playing field regarding trade. After much pressure and discussion, on July 21st, 2005, China revalued its currency, allowing it to appreciate by 2.1% against the US dollar. Also, China scrapped the peg. The currency no longer moves in tandem with the US dollar. Instead, the Chinese currency is now pegged to a basket of currencies. What's in the basket? Well, the major weightings include the US dollar, the euro, the Japanese yen, and the South Korean won. Minor weightings include the British pound, the Singapore dollar, Malaysian ringgit, the Russian ruble, the Australian dollar, the Thai baht, and the Canadian dollar. It's important to note that China has not revealed the exact percentages of each currency in the basket. Please understand that China competes with other countries such as Japan. Both countries are export-driven. And China's revaluation had a profound effect on the Japanese yen. The day that the revaluation was announced, the US dollar-Japanese yen pair fell about 300 pips. The average range for that currency pair is approximately 100 pips. And you can see on this chart that large red candle indicating a sharp move down in the US dollar-Japanese yen currency pair due to the effects of the revaluation of the Chinese currency. Because the revaluation makes China's exports a little bit more expensive, Japan and other competitors are expected to benefit. So, whenever China makes moves to allow their currency to strengthen, we tend to see strength in the Japanese yen. The move that China made in 2005 is considered to be the first in what will be a series of steps that will eventually end with a free-floating Chinese currency.